Ready? Okay. Good afternoon. Welcome back to 4 Days of Focus on Forex. I'm Jennifer, and today we are going to be looking at day number 4. Our focus today is going to be about what you do after a loss. Now that you know what information you need in order to trade and how you're going to get that information and how you're going to put that information to work for you, all things that we learned from Focus Focus on Forex day number 1, 2, and 3. The last focus is what you do after a loss. And so this is not a comprehensive everything you need to know in the world about trading in 30 minutes class, but this is just going to be some ideas that I'm hoping will be useful to you. I always like to look at things in a little bit different light, with a little bit different angle, maybe than what you've been told before or what you have been accustomed to. By now, you know how I do. I like to start things off with a quick review just so that we're all on the same page. So let's do that now. Focus number 1. You're on a need-to-know basis. This is going to keep you from being distracted when you spend hours looking at your charts and all the different bells and whistles that I know are out there. Just remember that a lot of that is fun and a lot of that is just a distraction. And what you really need to do when you're ready to be serious about trading is focus in on what you need to know. And so here's your need to know information. Direction. Will the market move up or down? How much profit will you take from the tradable space that you're about to participate with? When will momentum show up? And about how long will this trade take? Or even when do you expect it to start moving? I guess that's the same as momentum. That's your need to know information. So you want to get the information quickly. This is a really, really eye-opening point, I think, when you realize that it takes about 10 minutes. And so many people spend hours and hours and, you know. Everything you need to know can be found in your charts in about 10 minutes. And here's the information you need to find out. Identify your pattern. You need to calculate your profit target. You can do that based on a 10-bar average. You need to identify when you expect momentum. And a real good trick is that it starts and ends at the 50 simple moving average very often. And you can expect the market to do something for a while, and we define a while as 30 bars of time, and then it will likely start to do something else. So all that information can be identified and found in your charts, and you can do it in about 10 minutes. Another point that I really want to bring to your attention is, where does the move start? This is a really important thing to keep in front of you. Know where the pattern starts. Well, first know the pattern, know where it starts and where it ends. And every time you trade, your probability of success is based on 1, the proximity to the starting point, because that's where you can expect momentum, and you can stay close to the stop line. This is going to keep you in the game as long as possible and prevent as many of the devastating blows as possible. And number 2 is, how many bars into the pattern are you, so that you know the probability of it continuing versus the probability that maybe it's going to be winding down and getting ready to do something else. And that brings us to focus number 4, which is what we're going to talk about today, what you do after a loss. And what you do after a loss defines you as a trader. So if you ignore the hole in the bag, you will continue having the same problem. And what you do after a loss defines you. Are you going to be defined as that guy with the hole in the bag? Or are you going to be defined as that really smart person that was quick to identify the problem and quick to do something about it, quick to learn from it, quick to use opportunities that actually are going to be there for you? And that's what I'm going to show you today. Most losses are good, actually. Actually, I'm going to show this to you. How most of the time your losses are going to produce something good. They produce information. They're followed by a second or sometimes a third opportunity, and sometimes that second opportunity is even bigger. They teach you what to look for in the future, so you might learn something. They show you what the market is trying and failing to do. And basically, they're just going to whip you into shape if you pay attention to them. So I want you to start thinking of losses as a good thing, something that you should pay attention to. 90% of the time, the loss occurs because the market's timing wasn't there. And it's one of those things that you can't control, because guess what? Nobody knows the market's timing. Nobody knows exactly when it's going to move or which way it's going to go. That is just a true statement. So if you take a trade and you lose, I want you to know that you weren't wrong. It's not possible to be right about predicting the future unless you claim to be a psychic. And maybe you are, but I'm not. So, and most of us aren't. So if you keep this in mind, that it's not about being right when you decide to take a trade, it's about being ready to follow what the market is showing you. And there's so much information there for us to pick out, even when there's a loss. Now, I want you to remember what we talked about. Remember what we talked about? Don't you love it when your mother said that to you when you were a kid? Remember what we talked about? No, I don't remember. But you do remember the point of knowing where the pattern starts and when to expect momentum is that you have expectation. Expectation is everything. There's no shame in a loss that occurs as a result of the market doing something that's normal for the market to do. If the market's in a trend, we have an expectation about market behavior based on what we know about trends. And if the market's in a range, we have an expectation about direction and duration and, when and how would be a good time to trade that particular pattern based on the repeatability of it. So we have expectation, and that is something that I want you to make sure you never forget, because it is normal for the market to start and stop and start and stop and start again. Many times, sometimes, before it actually makes its way through a pattern. That's not right or wrong. That's just how it goes in the market a lot of the time. Here's an example. This is an example where the market was in an uptrending pattern. So we had some uptrending activity, and then at this point in time, maybe it was going to drop below the 50 simple moving average and enter into this space that I call the inside range space. And so it started and it stopped. And instead it went back into the uptrending pattern. So imagine if you had sold here and then the market timing wasn't ready for that inside range pattern and you just held on to it, you would have a much bigger loss than was necessary. So it's not about being right or wrong. It's just about being ready and saying, okay, market timing wasn't there, I'm out. And then it comes back down and it starts into that pattern again and stops, starts into that pattern again and stops, starts and stops, starts and stops, starts and stops, until eventually it makes its way through the pattern. Now, this presentation I'm giving you right now is not to teach you this particular strategy. This is a trading strategy that we do all the time in my trading group, but this is not what this class is about. The point here is that it's normal market behavior to start and stop and start again. And so if you get into a trade and the market timing wasn't quite there and it goes back on you, the very best thing that you can do is take your loss and take the information and figure out what comes next. I'm going to tell you more about that in just a second. Expectation gives you the right to trade, right? We know the market does repeatable patterns, and we learn those repeatable patterns, and then we can we anticipate market behavior, and we have an expectation about what comes next, and that's why we can trade. So expect a range to show evidence of indecision, disagreement, return to center. Whereas when the market's in a trend, you're having an expectation that it will show evidence of decision, agreement, continuation, urgency, drive, backup, agreement. All of those kind of things go along with trend behavior. So expectation is really a big deal. You don't have to wonder if you should close a trade or not if it moves against you. If the market does not do what you expect based on what you know about trends and ranges, then by all means you should close the trade and do it as soon as possible. Don't wait around and say, well, I know it's normal for the market to start and stop, so I started and then the market moved against me, but I held on to it because I thought it might start again. So a better thing to do is to have some urgency about you start and the market moves against you and you exit the trade exactly when you should, knowing that you weren't wrong that you didn't necessarily make a mistake, but that the market does that sometimes. And because there's always a danger that it could actually reverse on us, there is absolutely no reason to sit there with a dangerous situation and wonder if you should do something about it. So when you already know, you act quickly. If a bee is about to sting you, you don't have to wonder if you should brush it off, right? It might not sting you, but it might. So are you going to sit there and wait and see if it's going to sting you or not? And that's exactly the picture that I want to bring to your mind when you get into a trade and the market starts into your pattern, and then the market timing isn't there, so it stops and it goes back against you. And you dump the trade, not because you think that you were wrong or that the market might not come back and do it again, but if it does come back and do it again, you're going to be there and you're going to be ready to take it a second time. And I'll show you what I mean in just a second. But the point is, when you already know that the market has moved out of the correct position for your trade, I'm encouraging you to not hope, but to remember, it's like having a bee sitting on your finger, and you're not going to sit around and hope it doesn't sting you. You're going to brush it off. You're going to exit that trade as quick as possible. I mean, unless you're a beekeeper, and then you know something I don't know. So luck has absolutely nothing to do with it, even though I am doing this whole 4 days of focus on Forex for the luckiest month and in the theme of St. Patrick's Day. But all jokes aside, luck has nothing to do with it. Would you rather be lucky and be lucky once in a while, or would you rather be smart? And I will just tell you right now that no matter how lucky you are, if you choose luck over being smart, you're going to have a losing Forex business. And so what that means is, would you rather know that you can get 10 pips, or would you rather hope you might get 100 pips? And this is a really important question to put to your own self, because I think that there is a huge majority of traders who could get 10 pips on a really regular basis, and they don't, and they end up losing their money because they're hoping they might get more, or because they take 10 pips and then the market kept on going and they felt like they did something wrong, or like they could have got more, and then the next time they try to do that and they mess it all up. That is a person who's hoping to get lucky. And I don't want you to get lucky in your trading. I want you to get smart in your trading. So that's what the loss is all about. There is no shame in a loss that occurs as a result of the market doing a normal thing. It starts, it stops, it starts again. It starts, let me get my little pointer. And maybe you tried to sell, it stops, and so you stop out, you exit the trade, and you're ready for it when it starts again, and it really is ready to move in a better pattern with the market timing. So were you wrong when you tried to sell it here and you had to stop out here? No. And were you feeling bad about that, and so you weren't ready to take the next trade when it was ready to go? That is not taking advantage of the loss. And if you take the sell here and you let it run against you, and up here you're thinking, well, I'm just going to hold on to it because it might just start and stop and start and stop. Jennifer says that's a normal thing, so I'm going to hang on to this trade. And I'm telling you that's the wrong thing to do, because it could have just as easily taken off in the opposite direction. And then you have a runaway loss, and then the next thing you know, it's a loss that's so big that it took away all your gains for the whole last month or worse. And all of that was preventable when you just said, now I'm in, now I'm out, and if the market comes back with better timing, I'll be in again, as an example. Losses are going to happen. It's not about being right. It's about being ready. Every loss is followed by an opportunity. So that's why I say losses are a good thing. Yes, an opportunity. So I'll tell you what they look like. Maybe it's an opportunity to learn. Maybe you did make a mistake and now you can see it and you won't make that same mistake again. And I want you to think about reviewing your need to know information. Or number two, the market reversed. You're out when you should be and you avoided a runaway loss. That was really that was an opportunity to stay in the game and not allow something to become a big problem that ruins everything for you. Number 3, the market timing was not there, but you won't miss it because it will try again, and when it does, you're going to be ready. You're on to that. You understand that that is a normal thing that the market does. And it doesn't mean that you don't take your loss. You do take your loss, but then you don't miss your opportunity to get back in on the same exact pattern when the market comes back with better timing. And number 4, when the market tries and fails to get into a pattern, now you have definitive information that you can use. And I'll show you more about that in a minute. Okay, so when the market tries and fails, this is actually the minute I'm going to tell you about that. if it keeps on trying, if it just stays on it and it keeps on trying, maybe 20 bars or something, probability favors that it will happen. So if it tries and fails, but it stays right there, and it's back trying again and fails, and it's back trying again and it fails, and it's back, and it just won't give up, and it's not, maybe it can't get past a support resistance level or something, but for whatever reason, something's holding the market back, but it's staying right on that, attempt. Eventually, the longer that goes on, the more probability favors the fact that it is going to succeed. Okay, and we'll contrast that to if it tries and it's met with total rejection. So it tries once and it massively turns around and goes the opposite direction, then you know to expect the opposite pattern. It's showing you complete rejection of whatever thing it was just trying to do. And I have a picture that's going to demonstrate both of those things here. So in this example, this is what I call an outside range pattern, when price is ranging around the outside of my moving averages. And this is a space that, that maybe I would want to sell. And so this is actually an example from today, and I actually think this one did go up. But in this example, this is an outside range, and again, this is not a class about strategy, so I'm not here to explain all the ins and outs of the outside range pattern and the strategy and how you trade it. But what I do want to show you is my expectation is, because it's a range, what's the direction? Direction is to return to center. So center is always going to be that 50 simple moving average. And so at some point I'm looking for it to drop back through this box, back towards center. Okay, so maybe I sold this, and maybe what happens next is that it well, first off, what I want to say is every time it tried to come back and revisit the highs, it's showing me failure to behave like a trend. So we had complete rejection of the idea of making higher highs and sticking with the trend. We tried again, complete rejection of sticking with higher highs and going into a trend. And all of this is pointing towards the range pattern, which draws back towards center. But if it keeps trying, and trying, and trying, and trying, and trying, and really trying, and getting knocked down, but coming back, and coming back, and coming back, then probability really favors that if it's going to stay on it really intently like that and really not give up, probability favors that it will succeed in getting into that direction. As opposed to if it tries and it's immediately met with rejection, probability favors that it is showing you failure to do that other pattern, and probability is it's going to make its way through. There's only two patterns, right? Trends and ranges. So it's either going to push for that trend or it's going to drop back to the range pattern. And so I want to just go back to the previous slide and just say, is something to take note of when the market tries and fails. If it tries to get into a pattern, and it keeps, not succeeding, but not giving up either. It's not giving up. Then probability is going to favor that it will eventually break through and it will happen. And the opposite is if it tries and it's met with a complete and total rejection of that thing that it was trying to do, then you know to expect the opposite. And so that's really the beauty of there only being two patterns, is that you have an expectation of what it should be doing, so you can identify when it tries and fails to do that and take that as information that will serve you. So keep your need to know information handy, because after a loss, you're going to want to ask the same questions you asked before you took the trade. Do you still want to be in this trade if the market goes there? Do you still see direction? Can you still anticipate momentum? Where it starts, profit potential, timing, all of those same things. And if the answer is yes, then you want to be ready to take that trade a second time, because chances are the market's going to the market timing wasn't quite right for the first one, but when the market's timing is right, and only the market knows that, it will come back and you won't miss it. You'll be ready. So you ask those questions and you immediately identify, yes, I still like this trade, and if the market goes there, I still want to be in it. It started, it stopped, I exited the trade, but I'll take it again if it goes back because, everything still looks right. Then what you do is you immediately place a pending order so that you can get right back into that same exact trade if the market swings back into your pattern with better timing, and it takes you about 1 minute to make that decision. This is a 1-minute decision. This is not the time where you feel sad and you feel like you made a mistake and you have hurt feelings and you're kind of mad and like you're frustrated and stupid this and that, how that goes, right? As opposed to, oh, it started and it stopped. If it starts again, I'm in, because I reviewed all my questions and it's still right on, and it took me 1 minute to make that decision and put my pending order right back in place. So that's how fast it should take. After a loss, you need to figure out, why did it lose? The market started and stopped. Maybe it's waiting for something and it will try again. In that instance, you're going to be ready. There's just no reason not to be. You've already done the work of identifying the tradable space, the point of entry, the pattern, your expectation. None of that has changed. Then you really want to make sure that you're ready so that if it starts and stops and starts again, it doesn't start and stop you out and then you lose because you weren't ready when the market was ready to come back with better timing. Number 2, the market maybe pulled out of the pattern and changed direction. And maybe that's the reason why your trade lost. Maybe there was no agreement, no decision, no commitment. Or, maybe there's still time. Maybe it's just, waiting for something to pass. Maybe there's something on the economic calendar that the market was waiting for, and as soon as that event passes, it goes through your pattern. Or maybe it's Friday, and the market just isn't going to take a risk on this move until next week. There's always information in there that you can figure out when you're paying attention to the fact that I took the trade, it moved against me, I took my loss. Why? Why did that happen? Why did the market not complete the pattern that I was trading? And when you take a minute to look at all that, you're gonna definitely have some good possible outcomes. Okay, so here's 4, seems to be our lucky number. 4 possible outcomes when the market moves against you. You close the trade and you get ready to take it a second time if the market comes back with better timing. In this instance, you win. Or number 2, you're ready to take it again, but the market does not come back. So you smartly avoided the big loss. Good on you. Really, you win again because you didn't end up holding on to something or having a bad habit of not being able to close your trades, and then losses become bigger than they need to be, and then it just takes you in, you just spiral out of control. Now it's all negative and blah blah blah, and we've all done it. We've all been there. So end that today, right? Period. It's over. Number 3, you made a mistake that you now see, so you learned something. You win again. And number 4, the market is showing you what it cannot do. And by a short process of elimination, you know what it will do next. Now you have more information than you had before. You win again. So this is a really good way to view your losses. So what about when you're not sure? Well, if you're unsure whether or not your dog can jump the fence here's the thing. Let me say this the right way. You are unsure whether or not your dog can jump that fence until you see him try and fail. And that is just the way it is. And I don't know if you've ever had a dog and a fence and you thought the fence was good enough, but then the dog jumped over the fence. Well, now you know. And so you have more information. Now you have to build a taller fence because now you know, because you have experienced the loss of your dog. So your loss produces evidence when it tries and fails. When your trade tries and fails, now that loss has served you in some way. Make sure you're using that information and making your next plan accordingly. When there are only 2 choices trying to arrange, if it can't do one thing by a very short process of elimination, you can see what it must do. There's only one other thing it can do. So if the market's, here's the thing about the market. Start and stop, right? And that can happen for a while. But we already know what a while means. the market is not going to keep trying and failing forever. So when you see it trying to get into a trend and being shot down, and trying to get into a trend and being shot down, trying to get into it, and it just won't quit, and it's trying and trying and trying, then you like give up and say, well, this thing's never going to do it. Well, that's just not true. The market is not going to keep that trying and failing pattern going forever. Eventually it makes a decision, and it will either move into the trend or it will fall back into the range. And we already know that 30 bars is a good definition of a while. So after 30 bars of time, you really should be, those eyebrows should be going up, and you should be going, oh, I don't know, I think something might be coming up pretty soon. So here is an example of taking all that information and being ready to use it. In this instance, we had a downtrending activity, and when price came back to the 50 simple moving average, maybe in light of the fact that we had some outside range going on before, maybe I was anticipating we would have another outside range pattern that would look like those gray arrows. But what we got instead was a failure to go into that pattern, a third failure to go into that pattern, second failure and a third failure to go into that pattern. Eventually price returned to the downtrending pattern. So it's sometimes hard to wait it out, but as you're waiting it out, and especially if you try to trade it and you take a loss, you can go back and say, all right, there's an opportunity to gain more information here. And so what is the information that I can now gain in light of what the market is failing to do? Now I have evidence that there's only one other thing it can do, and I'm going to get ready for that. Here's another example. Will the uptrend continue, or will it complete the range pattern again? So I just put a little bit more history on this chart. So we had some uptrending activity, then we dropped into some range activity, then we had some uptrending activity, and pretty soon it gets to a point where you have to wonder, is it going to go back into the trend, or is it going to drop into the range pattern? And here it's the first time it fails to go back into the trend. This is what it looks like when it succeeds. It hits the 50 simple moving average and it goes back into the trend. Here it hit the 50 simple moving average and failed to get back to that high. Tried again, tried again. And so we have some evidence for the range pattern coming, because we can see that it is failing to get back into that uptrending pattern. And we also know that it's been in the uptrend for a while, so maybe it's time for it to spend some time in the range pattern. And again, this is not a comprehensive course on how to trade this particular range pattern. It's just a demonstration of identifying if it's not doing one thing, it's going to do the other. So you can take that information and use it. It's not about being right. It's only about being ready. That's all trading is. So here's another sort of example of the same. We had some uptrending activity, followed by some range activity, returned to the trend, made a little higher high, and then we came back down to the 50 simple moving average, where price dropped below both lines. So maybe I drew this box anticipating a wider outside range pattern. Maybe I wanted to sell it here, and then maybe I had to take my loss when it turned out that market wasn't ready to do that. So I stop out here. So at that point in time, I'm ready to take it again if it comes back with better timing, and failing that, I could be ready for the only other thing that it can do, which is return to what I know already is existing, which is this uptrending pattern. So it's taking all that information and saying, I don't know, it's not my job to know the future, but if it comes back to this pattern, I would not have hesitated to want to sell into that potential range pattern. And the fact that I took my loss here, I didn't get a chance to get it back here, but how much better was that than waiting until here or here or here and finally saying, oh shoot, we're back in the uptrending pattern. How did I miss that? So taking a loss, and being ready for whatever comes next, it's not about being right or wrong. The loss wasn't wrong. It's not your job to be a psychic. It's your job to know your need to know information. What is the pattern? What is your expectation for that pattern? What is direction? Where's the line that tells you that it's no longer in that pattern? And you break all that information down, that very short list of need to know information, and it really keeps you true to what you're doing. It's like putting a puzzle together. Direction, check the pattern. Profit potential, you can calculate it. You can look for the edges of your pattern or something else. Momentum, you can watch for price to cross that 50 simple moving average and demonstrate decision. Time, well, the market does something for about 30 bars of time. And in this class, we didn't talk too much about time of day, but that would be one more thing that you could add to your list, because business happens during business hours. So you want to kind of keep that in mind. And we have 4 possible outcomes when you take a loss. If you close the trade and you take your loss, you want to get ready to take it a second time if the market comes back with better timing. And I'm going to tell you right now, about 90% of the time, that's exactly what's going to happen. And you win. And the rest of the time, the other 10%, you're out at a really reasonable loss level where you should be out, and you did exactly the right thing. Number 2, you're ready to take it again, but the market does not come back. Smartly avoided the big problem, and you no longer are being subject to these runaway losses where you don't know what to do and you had to sit around and think about it, because now you're going to think about that bee sitting on your finger, and you're not going to sit around and think, gee, I wonder if he's going to sting me, right? You're going to be like, get that thing off me. Close that loss immediately before you can get stung. Number 3, if you make a mistake, you get to learn something. I know we're reviewing this now, and we're going to review the whole thing here in just a second. And number 4, the market is showing you what it cannot do. By process of elimination, there's only one other thing it can do, and now you have more information and you win again. Okay, total review of 4 days of focus on Forex. Charting is all about defining the pattern. So no more wasting time, staring blankly, messing around. If you're serious about trading, get serious about this and go to your charts with a list of things that you need to learn. The pattern produces the expectation about market behavior, trend or range. There's only 2 patterns, so make sure you know which one is driving before you trade. Trends, you can expect it to continue in one direction. Continuation in one direction is the main thing trends do. Expect it, higher highs or lower lows, depending on if it's an uptrend or a downtrend. They start and end from the 50 simple moving average. Just some good tips to remember about trends, and now you're 50% there. Here's the other 50%. Ranges, expect it to turn back. It's the opposite of a trend. It doesn't continue. We expect the market to find a previously established high or low and then return to center. It can swing high and low, but it always comes back. It might be wide, it might be narrow, but the one sure thing that we know about ranges is that it's going to return to center. That's what makes it a range. You must do this. You must define the pattern. Calculate a reasonable profit target. You can do that by taking an average of the last 10 bars in whatever chart or time frame you're trading. Momentum starts and ends from none other than the 50 simple moving average. I mean, it could not be more simple or clear cut than that. Keep in mind that the market moves for about 30 bars a time. That's your definition of a while. And last but not least, what you do after a loss defines you as a trader. You don't want to be that guy with a hole in his bag, right? You don't want that to be you. This is not the time to get weak or scared, because losses produce the information that you need. So let them help whip you into shape, and don't begrudge them. Be grateful for them, because they're going to help you get the information that you need. When you have more information, the next trade is more stable and 90% of the time even more profitable. All right, you made it to the end. Thank you so much for joining me for 4 days of focus on Forex. I hope I have brought into focus a few important points that will serve you well. And it doesn't have to end here. I hope you'll stop by jenniferforex.com and just sign up for total access. Even if you only want to try it out for 1 month, it includes all this and more. Plus, I get to spend more time with you, and that's going to be something we can do starting next week. That'd be awesome. But that's it for now. So thank you for joining me for this class, and I'll hope to see you inside Total Access. Have a great rest of your day.